So welcome to this evening's webinar on real estate risks and how to minimize them. So we're going to be talking through a number of different areas where you can utilize what we're going to talk about tonight to de-risk your property deals and the reasons that you may want to do that. So I'm going to give it just one more minute because I think there's a couple more people still to attend who I know are coming. Anybody who hasn't already, just pop a hello or something in the chat box just so I know that you're there and that you can hear me okay. So I think we're just about there. One more moment. So the audio seems to be fine. That's good. Listened to a webinar a couple of weeks ago, and I think for the first 6 or 7 minutes, we couldn't hear anything. Must have been a new system for whoever was, I can't remember the person who was presenting now, but they must have had a new system and they weren't quite sure how to use the audio. Or there was some technical problem, you just don't know. So it's good everyone can hear. So I'm going to start off now. We've got, I think, pretty much everyone who was expecting. As I said, this is being recorded, so you'll be able to refer back to it later. So you don't need to screen snap or make notes if you don't want to. If you've got questions, keep them coming throughout the session. And if it's kind of relevant and I see it at the time, I might answer it. If not, I might just save up all the questions to the very end. And we'll go from there. So thank you very much for everybody taking time out tonight to come and listen to a talk on de-risking property deals. And the title of this webinar is Real Estate Risks and How to Minimize Them. So this is based on my own experiences over the sort of last 15 years or so of working in business and property. So some of the things we're going to cover tonight. Who is Lee Warren? Some of you know me, and I know some of you don't. So it'd be good to get that covered so you know where I'm coming from. Some bit of feedback about me. And then we'll be talking about the real estate risks. And then right at the end, we'll have the Q&A. So for those who don't know, I'm Lee Warren. I run a property consulting firm based just outside Kettering, halfway between Peterborough and Northampton. I'm also London-based as well from time to time. I also run a property development company that's also based in the same location. But I started my sort of adventure in property and business back in 2002, working for investment banks and asset management companies, where I got a really good sort of feel for analysis and spreadsheets and formulas and ratios. I had a look at numbers and really dig down deep into finding the real meaning behind the numbers. Worked for some companies like Royal Bank of Scotland, Bank of America, Merrill Lynch, Deutsche Bank, Fidelity, BlackRock, as you can see, First State. And then in 2008, I was headhunted for a company called Bouygues UK. They're a huge international construction company, build commercial and residential projects. And I had a responsibility as a management accountant on 7 different projects. And the total GDV for those projects was around about £2 billion. So I was responsible for all the accounting on those projects, making sure that the numbers were accurate and correct and were updated regularly, and that the projects moved forward correctly, liaising with the directors of the business and the project managers on the ground. So this is where a lot of my knowledge culminated in really getting used to putting numbers together for property deals. And all the work at the banks and the asset managers before this was like the priming period where I just really got the knowledge in my head and working as the management accountant was where I actually put it into practice. So some of you may know I work for Bishopsgate Developments. I was the director of acquisitions there, looking at modular developments before returning back to Warwick Homes, my development company. And I've just exited a large conversion and refurbishment project in Hinckley back in December. That was for 14 apartments, so it was quite a large deal. It took when I exited, it was about an 18-month project. So here's some quick green images of the Hinckley project. It's the one I've just finished, and so obviously as a developer, I don't just support people with my consultancy business. I actually do what I say I do. So it's like I like to practice what I preach. So already looking for the next project, and we have 2 projects lined up that we're likely to get involved with over the next couple of months. And we're just finalising the due diligence on those. They're large-scale new builds. Well, one of them's a new build and one of them's a conversion of apartments just outside Kettering. So they're going to be rather exciting to get involved with. Words from some people who have worked with me, either in mentoring or on the workshops. I'll just read a couple of these. Another exceptional day of training. Thanks, Lee Wazzy Warren. A lot learned. That was from Simon. And Sasha has said, a massive thanks to Lee Wazzy Warren. You actually made spreadsheets interesting. You put it across in a way that was easy to get my head around. And that's saying a lot from someone who's scared stiff of numbers. An amazing day. So very kind words there from people who've worked with me. And it's always really nice to hear that the value that they get from talking through how to look at the deals, how to find the risks, how to ensure that the analysis is correct before they make offers on deals. So real estate risks. So this is really, it's part of your due diligence, which I always incorporate with the deal analysis, because the analysis on its own just doesn't stand alone. Risk assessments is vital to ensuring that we know exactly what we're getting into. So one of the questions a lot of people always ask, and I mean, I asked the same question as well at the very beginning when I was getting started, how much analysis or how much risk assessment do you need to do on a project before you go, yes, it's worth it, or no, it's not? It's a tough question because every deal is going to be slightly different unless you're doing the same type of deal over and over and over again. If you're buying if you're buying a semi-detached house and you're flipping it, it's taking 3 months and you're spending roughly the same amount of money each time, then you can sort of benchmark your risks within those deals. But if you're doing different types of deals, different sizes, different scales, different amounts of money being invested into these deals, then it's very difficult to say this, X is the amount of analysis you need to do. So it's very deal specific, and there's too many different ways to highlight every single scenario. So one of the things that we're going to think about is when I'm looking at deals and I've just completed the analysis, there's a number of different risks that I'll look at, and they start with planning. So my business typically is around acquiring property to build on, either new builds or conversions or large-scale refurbishments. So I'm going to be looking at properties more than likely with planning. So that's one of my first risks I'm going to be looking at. So I'm just going to list down a number of risks that are relevant to me, but will likely be relevant to you as well. So start with planning. Location is another important factor. Have I done the detailed analysis? Because there's 2 types that I do. There's a headline analysis and then there's detailed. And I see some people, they'll do a hybrid of the 2, or they'll just do a quick analysis and then they'll start making offers. But I think it's important to ensure that you understand every aspect of all the numbers that's involved with your deal. So you can only understand that once you've done the detailed analysis. And that's when you drill right down into the individual specifics. I need to look at the sensitivity. So that's, it's how sensitive are prices to change, and what will the impact be of that? to, say, price, sales price, for example. I need to double check all the numbers that I'm working with. So I'm looking at the GIA. Have I got the right numbers? Am I looking at the right conversions from from meter squared to foot squared? Sometimes I see spreadsheets that clients send me or a prospective client will send me, and some of these numbers are wrong. They may be working with numbers too high, and it shows the deal not to work, or too low, and it shows the deal working really well. And as soon as you start moving these around to where they should be, it changes the picture of the deal. We need to look at contingencies. Have I got the right level of contingency? Am I discounting any of the sales prices? Because whether you're renting out at the end, if you're sort of like building or developing to rent or sell, you still need a sales value so that you can either put a commercial mortgage on it or whether you end up selling them. And discounting I'll come to later because some people might not understand that. They understand sales prices, but the discounting of sales prices, how does that work? So we'll cover that later. Working with the right professionals. Now, this is a huge risk. And, I've come unstuck in the last year with this, with main contractors, for example, working with the wrong people. And they can mean you go over budget, you go over schedule. You might have to remove them from the site, which has a legal implication. So there's a number of risks here. It doesn't end with the main contractor. Most of the professionals can possibly, depending on their involvement in the project, bring a number of risks with it. The socio-demographic data that you can look at for the area that you're looking to buy or develop, and that will give you an insight into what's relevant for that area. Making the correct offer price. What is the offer price? What's the target price that it works best at for this deal? And not going over that. So many people work out what the price is and then they go and offer more. There's liquidity. And what does that, how does that impact your deal? And what is it? Some people don't even know what liquidity risks are. There's finance as well. Finance in the form of the conditions that may come with the finance, the rates, the fees. Some of these you may be overpaying. So this is just the sort of stuff that I would start with. And it's not every one of these is going to be totally relevant to your project on every deal. Most of these may be to one degree or another. So a question for you all. If the return on a GDV project, a deal that you just analysed, comes back at, say, 25%, would you automatically be thinking, yep, great, I'm going to make an offer on this now? So just a quick, in the chat box, sort of a yes or a no. Let's just see what people come back with. Because 25%, but it sounds pretty good on the GDV. So some of you are saying yes. Some of you are saying depends on different factors or on the numbers. Any more yes or no's or in-betweens? So some people think yes, some people think no. So the answer really is, once you've got the analysis complete in terms of the numbers, it's going to depend on the risk that's needed in order to achieve that return. Because if the risk is really high and you're getting 25%, then that may not be enough to make this deal worthwhile. Because you need to look at how likely those risks will come to fruition. Or if it's low risk, maybe 25% is maybe asking a bit too much. And, you go back to the vendor and they're like, well, you need to offer me a little bit more because this is a low risk deal. So yeah, there's a number of different ways you can look at this, but I would always add the risk element, which is the reason of our sort of webinar training tonight. So the risk comes with the risk return or the risk reward, and it's a trade-off between these two all the time. So we can plot this on a chart. We can have the risk at the bottom, or the standard deviation, and that's obviously starting on the left-hand side at low risk and going up to high risk. And then we have a return, starting at low return, going upwards to a high return. And as this arrow goes up, obviously we're going to start from low risk and low return. And the more risk we take, it's going to take us to higher risk and higher return, potential return anyway. So this is what we need to think about, that if we want a high return, we potentially need to be taking a higher risk. Not always, but that's the potential. And if we want to take low risk, we have to sort of expect that the returns will be lower. And I know a lot of people like to think that they can find low risk deals with high return, and they don't really exist. Maybe once in a blue moon, but I've never seen one in all the years that I've been working in business and property. Risk will always be higher if the return is potentially higher. So we need to bear this in mind and think about this whenever we're looking at risks. So we have to ask ourselves the question, how much risk are we willing to accept on a deal? What's our appetite? And you'll hear this a lot. Appetite for risk. What is it? What is our appetite? And it basically means how much risk are we willing to accept on a deal, whatever the deal may be. And we could look at it on a chart like this, that in the bottom left-hand corner, we're going to have low likelihood and low impact. So the likelihood is it likely to happen? And the impact is, what's the impact of that thing happening? And it could be any of the risks we're going to talk about today. So if we want a low likelihood of something happening and the low impact, then we're looking to be within potentially our risk appetite. So we're quite happy to take on that risk. Let's say we've got a bit of a medium likelihood of something happening and a medium level of impact. That might start putting us into the point where it's starting to exceed what we're prepared to accept in terms of the risk. And obviously, the higher we go in each direction, the worse it's going to get. So the idea is to be somewhere within the dark green, and you might find that sometimes there's risks that are out there, and the likelihood of them happening are high. But the impact of once they have happened, the impact to our business or to the deal might actually be quite low. And a very silly example, I suppose, not property related, but let's say, if your postman has got to deliver mail to your house, but there's lots of snow, so the likelihood of him actually being able to deliver that mail is, not deliver that mail is very high. But unless you're waiting on a really important package, the impact of him not delivering 9 times out of 10 a normal delivery of mail is quite low. It's not going to impact you at all if you've got to wait a couple of days for your normal mail, even though the likelihood that it's going to happen is high. So think about this as we're going through some of these risks. So planning. Some of these are going to be quite simple. So planning, you might find a deal that you've got an interest in, and there's no planning involved at all. So that could be a huge risk, piece of land. You're looking to buy it to build houses or flats or something, but there's no planning. That means you've got to take the risk of acquiring the site, paying an architect to put some plans together, and maybe consult a planning consultant to get some feedback as to the likelihood of planning in that particular site. So you may have to put some risk capital up, and that's where the risk comes in, because you might not get planning. So you're taking a calculated gamble, and some people do have this as a business strategy because they're quite happy to take the risk, because with this typically comes quite a high return on planning uplifts. And I'd see some people doing this through crowdfunding as well. So you can crowdfund just for a planning uplift, for example. But it's a risk all the same. Whoever is funding it, crowdfund, your own money, a lender, whatever you're able to get in terms of funding, this could be a huge risk. You could acquire a property with outline planning. Again, you've got an idea of what's likely to be accepted on there because you've got the approval for outline, but you've still got to go through the full planning, and obviously you've still got to spend a bit of money with an architect to get the plans finalised. And obviously full planning, this is what I like. The deals I tend to look at have full planning because I know what I can do with the site, what's already agreed. It also comes with a set of conditions that I need to meet, so I can look at the conditions and say, okay, well, to achieve this, I need to do this and spend this amount and this amount and this amount. So it gives me a complete outline of what's needed. So out of the three so far, the most riskiest is going to be the one with no planning. And the least riskiest is going to be the one with full planning. So here we can already start to determine how we can de-risk this project straight away. So one of the things that I would be doing as part of my deal finding, when I'm looking for deals, is one of my tick boxes will be, does it have full planning? And if it doesn't, and it only has outline, for example, then I just have to tick another box that there's a bit of risk there. How do I mitigate that? And the last one is lapsed planning. So we know that it's had planning at some point, but now it's lapsed. And if it's been lapsed for some time, the question I would be asking is, why has nobody else bought this? Or why has nobody built this in the time that the planning, because the planning would typically have been available probably for 3 years. So it's going to get me wondering and asking questions around about, why has nobody built this out yet or developed it further? So there's a number of planning risks that we need to think about, and obviously this is more relevant to developments, but if you're buying a buy-to-let and you're doing a bit of work on the buy-to-let, or you're just doing a flip, you need to do some work within the house. Does it need planning? So you need to think about these things. And planning is quite an important aspect of any property improvement and uplift in value, because we need to do something to a property in order to lift the value. Is the scheme maximised? And I see this so many times that vendors will put a bit of planning onto a piece of land, or they'll have a factory and they'll put a piece of planning in for it to be converted, but they won't maximise the scheme. They'll just put something on there to get an uplift and try and sell it as quickly as possible. So it might not always be the best scheme that you see in the plans anyway. So it's always going to be worth talking to your planning consultant or architect and say, is this the best thing for this site? Because if let's say there's 10 houses or 10 flats that's in the current scheme, and maybe that scheme could take maybe 15 or 20 flats, and then you're maximising what's available and reducing your risk because you're offering more potential for the GDV. Location is the next thing I'm going to be thinking about. Is it rural, which brings its own set of problems? Is it going to be in a village? No matter what the size of the village, it could be a town or it could be a city. The first thing I'm going to be thinking about with something like a rural or a village, if people are going to move there, are they going to be working local? Are they retired so they don't need to go to work? Where are the nearest towns? What are people doing for transportation? Are there local transport routes? Does the bus come every day or every week? Is there a bus? Is there a train station nearby? If it's a town, is it a good part of the town? Is it a part of the town that's on decline? Or is it looking like that part of the town is rejuvenating? Same with cities. And we can see in some of the towns and cities that there's so many different, huge variety of areas where there's poverty and there's wealth. Obviously, we start developing and buying in the wealthy areas, we're going to pay premiums for that. That brings its own risk, paying too much. But again, if we're buying in a more rundown part of the town, once we've developed, the risk of people not buying it because the rest of the surrounding community is not going to be supportive of what we want to sell. People aren't going to want to move there. So looking at the location and thinking, is this going to work for this deal? The third, probably most important aspect of my risk is going to be making sure I do the detailed analysis on the deal. So once I've done the headline analysis, which is just really a summary, and it's something that probably takes me 2 or 3 hours on a deal. If the headline analysis shows that it's sort of ballpark of a successful deal, profitable deal, then I would be looking to do a detailed analysis, and that's drilling down all the numbers. So like on the hard build costs, I'll be looking to find not just a benchmark of say 12% of costs for the external works. I'll be breaking down all those items under external works and finding out what those prices are likely to be. And I'll go to my fees and my consultants and the surveys, and not just put a 10% in there based on a previous project that I'd done or a comparable that I'd seen through BCIS. I'll be finding out exactly what consultants I need. And that sort of ties back into, if I've got full planning permission, the conditions are going to give me some ideas what consultants I'm going to need and what surveys I'm going to need at the very least. So again, I'm de-risking all these sort of problems. But I'd never really move forward without detailed analysis, because all your numbers are going to be dictated by how much money you need to raise. And if you're going to raise too little, that's going to cause you problems. If you raise too much, that's going to cause you problems as well. And obviously the next thing straight after I've finished my detailed analysis is looking at sensitivity analysis. So that's where I can take a set of different numbers from my analysis. It could be the sold unit price, the pound per square foot build cost, and the percentage return. And I can say, what if some of these prices changed? What impact would that have on my profit? And I did a whole webinar a couple of weeks ago on sensitivity analysis. And so if you missed that, send me an email after this and I'll send you a link to it, because we had a whole hour of going through sensitivity analysis. But very quickly, it's a way of generating tables which are dynamic, so they update automatically. And so we're taking some core data from our detailed analysis. On the top row, you can see I've got some prices, and they're effectively the selling price of my project. So in the yellow, it's £282,667. And on the left-hand column, it's got the pound per square foot build costs. So highlighted there is £122 a square foot. So based on my current analysis, it's showing a 27% return. But what would happen if I was to not get the selling price of 282,000, and maybe I ended up having to spend a little bit more than £122 a square foot build costs? Well, we can see straight away through this sensitivity that it's going to move over and give us an 11% return very easily. And, having sold properties before, I know, sort of like expecting to say, maybe get 140,000 for a property and you only sell it for 128 or 129, 132. What's the impact of that? You need to know that up front so you can communicate all these risks to your shareholders, your stakeholders, your investors. Even the lender will do something very similar, and they'll check how sensitive it is to price changes. And if it seems to be too sensitive, they won't lend to you, or they'll lend to you at much more higher interest rates and fees because it's bigger risk. I'd most certainly be checking the numbers. Once I've done my analysis, I'll double check it and triple check it. And I might even get somebody else to check it as well. Because sometimes if a deal looks too good to be true, it normally is. So there could be an error in there. Maybe you've put some numbers around the wrong way. Instead of, say, £180 a square foot, you put 108. Happens all the time. And it's so easy once you kind of become number blind when you're doing analysis for a long time. So I'll be checking the numbers, because sometimes I do find mistakes, but you only find them by double checking. I'll be checking the costs of my build cost. I'd either be double checking through the BCIS. I'll be speaking to the builders who I'm hoping to get on board or who have done quotes for me. They may have done a quote and maybe it seems a little bit cheap. So I'd be double checking that the quote includes all the things that I'm hoping they've included that I want in my build. And this is it's not just relevant for new builds and conversions. You know, if you've got a builder coming in to put some new studs up or redesign the house for a flip or for a HMO or something, you want to make sure that what they've quoted is exactly what you need. So double checking these numbers is really important. So by doing this, again, you're de-risking because you're going to rule out any accidental mistakes in some of the numbers. And it's going to give confidence to yourself that they're double checked, confidence to your investors that you're doing this the right way around, because you don't want later on for some of these numbers to be shown to be wrong or inaccurate or incorrectly entered, because that's going to piss off your investor and they may well want to pull their money. So we don't want to get this wrong. Sales prices, which we've just sort of discussed on the sensitivity, how sensitive are those numbers for the sales? But we also want to make sure and double make sure that the desktop studies that we've done are what are in our numbers. The agents that we've spoken to give us their feedback on, 2 or 3 different agents on what's selling in the area at the time or what's sold as well. Any surveyors that have done surveys for us, just make sure that those numbers all stack up. And again, this is ensuring that we're just sort of like dotting the I's and crossing the T's. Making sure the plot size that we're working to is correct. Even if it's an extension or a garage, but something bigger can have a huge impact. If you're building a block of flats or a number of detached or semi-detached houses, if you're using the wrong size, then all your numbers are going to be wrong for the build. And the unit sizes as well. So obviously you need to just check these, and you can check them through the architect or the planning details. Sometimes the planning doesn't have all that information on, you have to go back to the architect. Sometimes you've got the ability to input the actual plans into some software and it can give you the sizes. You just need to make sure that the assumption on the size that you're working on, the GIA for example, is correct. You don't want to be out by 1,000 or 5,000 or 10,000 square feet and only find out later. It will kill you. So yeah, checking what the gross internal area is, because there's a number of different numbers that you can utilize here. GIA, GEA, NIA, and you need to know what each of these are and which ones you're working to. I've seen some people in the past, one project they're using the GIA, the next project using the GEA, and they didn't know that there was a difference. And there is. So I'd be checking all these numbers. I'd also be making sure that any conversions are correctly calculated. And meters, square meters to foot to feet square, square meters to feet square. You need to ensure that you calculate that properly. So divide it by 10.76, not 10.00. And again, the bigger the size you've got, the more out the numbers are going to be. Contingent.